Hi, everyone. It's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom series. Today's topic, the partnership model of doing business. Many are interested in this model because instinctively we sense that we can share knowledge and information, expenses, and things like that. So I'm going to cover some of these topics. By the way, the partnership that I'm speaking of is not the colloquial term that sort of denotes relationship among business colleagues. You know, we're all partners in this, or we're all part of the team, and that sort of talk. This term, partnership, is the formal business term that sets up a particular legal arrangement between people for partnership in business to, yes, share revenues and expenses and to collaborate in ways that are very powerful. And I'm going to speak about some of those. The typical partnership group that comes together is a group of people where there's a practice of a common interest, but the workload is large enough that it can sustain 5, 10, 15, 20, or even hundreds of partners. Some of the global law firms that you might be thinking of have actually hundreds of partners. The big consulting firms, they're all partners, or of course, if you're not a partner, you're a more junior employee. So typically, we're going to find that accountants, lawyers, clinics like psychologists, doctors, nurse practitioners, even some other professions will come together in a partnership arrangement. What is the arrangement? Usually it's under the taxation rules of a particular country like the US and Canada. Partnership rules are quite straightforward. The entity itself is a partnership, and it might have a registered trade name or a registered name under which it's carrying out its work. But the idea is that the income and expenses, and therefore the surplus or the profit, is distributed among the partners. And so the entity itself will report to the taxation authority some information, standard information that is called for. But the taxation occurs in the hands of the individual partner. Immediately, one has to think about tax planning for the individual as opposed to tax planning for the entity itself. How do you join a partnership? This is an interesting thing. You've heard, if you've watched television law shows, you see that, and you know this from your own personal life, making partner is a thing. It's a huge objective, and it's a great triumph when somebody makes partner, which means that they enter into that, hallowed territory of becoming a partner. And so let's take a couple of examples here. Let's say you have 5 doctors who join together in a practice. They're partners, and there's 5 of them, and so they will divide their expenses, their revenues, into 5 equal percentages, unless they don't do that. And I'm not being funny. I'm saying that sometimes a senior partner or somebody who brings particular expertise might have negotiated a higher percentage of the partnership. Maybe there's one that's 30% partner, and then all the rest are, maybe 10 or 15% partners. So the point is that when you initially set up a partnership, you divide up according to some agreement, and it's all papered in a contract and so on. But the idea is that partnership works together as if it were a corporation, and it's governed by rules that are similar to that of a board. They might have a managing partner, they might have a partnership meeting where there's a 1 vote per member, or perhaps 1 vote or a percentage vote, depending on the percentage of the partnership owned by that one person. So in other words, there are rules set up. And so when you set up a partnership initially, it's pretty clear and straightforward what the percentage is. The trick is, what happens if somebody junior to that starts working in that firm, lawyers, accountants, doctors, whatever, that person, it's held out to him or her that the partnership status can be achieved. So they do some fantastic work, they accomplish great things, they meet targets, they do all these things that matter to the partnership, and then suddenly they're made a partner. Well, does that mean that the partnership keeps getting fragmented? If you originally had 5 people, What if you had 10, 15, 20? Does that mean that the percentage of the partnership drops, and therefore each partner owns a succeeding kind of smaller percentage of the partnership? Well, it could, in the sense that some partnerships have rules. They say no new partners, period. And so anybody who works for us is going to be a junior employee, and that's it. Or some may have a limit, an upper limit. They may say, okay, we're starting out small. There's only 5 of us. We can divide up the work. We're almost fully busy with 5 of us. But we can see that this is going to grow, and we're going to end at 10 partners. And we're going to give each of the incoming partners their percentage so that we all end up at 10% each. But the new players who come in later might have to achieve certain performance targets before they are allowed to come in and equal share in the partnership. Or they may be given, a 10% share of the partnership, but the performance, the pay, you could say, the surplus, the partnership units that are given, the profit that's shared, might be on an inclining scale, starting off low and then rising later on as they continue to perform. You can see where I'm going with this. There's complicated formulas. One famous example is kind of a cascade model where the new partner comes in, and let's use our example of the 5 original doctors that came together, and they're doing their work and they're charging all their fees, and their business is growing. So the point is they're fully busy, and it's time to bring in new partners. And let's say, just for the sake of example, those 5 doctors have created a $5 million a year business. So they have fees, total revenue of, let's say, $5 million. So in a sense, that's $1 million of revenue for each of the partners. But let's say they have, again, let's say 50% of that revenue is cost. And so $5 million, half of that is $2.5 million divided by 5 people. That's $500,000 of expenses each. And if they distribute all of their surplus, all of their profit, then they're going to have $500,000 each as their annual revenue, annual income. And then from that, because that all passes through the partnership to the individual, they'll each file their own personal tax return. Or if they have a company and the company has a contract with the partnership, then it's a further complication. But at the end, it's the person or their management company that files the tax return and handles all of the income tax and expenses after distribution, any accounting, bookkeeping, that sort of thing, out of their share of the partnership. But let's get back to the situation where these 5 people decide that they need to find 5 more doctors to join their partnership. They've already got $5 million in revenue, and so if you bring in 5 new doctors, you don't want them to immediately start taking 1/10 of that existing $5 million, which will grow to $10 million, let's say. At that point, well, if they all distribute 10% each, they will be all back up to their $1 million. But that could take years. And why would the original partners do that? You can see the logic here. So what happens is you have this cascade model where, let's say, partner number 6 comes along, and he's all excited because he joins this partnership. But they say to him, but you're going to share in any revenue that grows beyond $5 million, which we already have in the bag that we've already established over the years. And so let's say they make, with partner number 6, an additional $1 million the next year. Well, that partner might share 1/6 of the $1 million. And then if partner number 7 comes along a couple of years later and they add another $1 million, making it $7 million, then each partner gets 1/7 of the additional income after number 6 has joined. So you can see it's a cascading effect. This is a common partnership model. What it teaches you is that, the early bird gets the worm. Get in early on a partnership, because it's possible that in your partnership rules or negotiations or discussions, you will end up with a cascade model like this. So clearly, joining a partnership it's a valuable way to do business, yes, but it can have consequences if you join a partnership late. Imagine also the question of getting your money out. It's not a company. You don't own shares. You can't sell your shares. You might be able to, with the approval of the other partners, transfer or sell, so to speak, your equity in the business. But because the income is passed through, what is the actual equity of a partnership? Probably it's the goodwill or the brand, the name, and maybe even, facilities. They may have bought a building, or they may have, purchased equipment and so on. So there is a certain set of assets that you could sell your percentage of to the new person coming in. But of course, they're going to get into this cascade model, or it's going to be a long time before they start to share in the partnership income. So that's one way to exit a partnership. Another way, and I've seen a law firm with 10 partners who all reached retirement age at the same time, which was a crisis for that firm. Can you imagine? What do you do? How do you sell an existing partnership and 10 people want to retire at the same time? This is a true story. They actually just dissolved the partnership, and they didn't bother with any complicated ways to sell. They had all accumulated high income for many years, and they were content to, dissolve the partnership. So that's an interesting thing. So if you wanted to summarize the pros and cons of a partnership model, I would say the pros are that you can have more powerful intervention, 5 people, 10 people working together. It's a more powerful entity in the marketplace. You can have some people to watch your back, so to speak. You can share expenses and revenues jointly, and therefore you have more control over things. You have more market power because you might have a branding strategy. You might have the ability to negotiate bigger contracts for your firm, something that, say, one doctor or one lawyer couldn't do. But if you have 5 or 10, well, then maybe you can handle the massive, gigantic files, let's say in global legal work. A one-man shop is not going to be able to get a big contract to do a multi-country agreement between various companies or joint ventures, whereas a powerhouse team of 10 hotshot lawyers, for example, could do such a thing. So those are the pluses. The negatives might be that in a partnership, you're one of many partners, and there might be a group think thing that happens. You may not be able to influence the direction of the partnership, but you're stuck, right? If you join a partnership, I would say that you have to be in for life, because to exit early, it's complicated, and there may not be any equity early enough to distribute to you. So you might risk 5, 6, 7, 10 years of your life, and if you have to exit, you may have a problem. And so I'm sure there's insurance for things like that. But let's say you have a health issue, or you're incapacitated somehow. Exiting early may not yield you something that you think you should have after X number of years working together with the same team. Another one of the negatives that you can see is that there's really no equity. There's surplus that's earned and distributed each year, and there might be surplus. Partnerships might set aside money for pension plans or different things like that. But you can see that's a complicated process. The negative ability also is you don't have time in a partnership that gets bigger and bigger to handle the affairs of the partnership, and so somebody is usually appointed a managing partner, or sometimes a professional outsider, a professional business executive is brought in to be the CEO of the partnership. And so it leaves the 5 or 10 doctors, lawyers, psychologists, whatever, to do their work professionally, but the affairs are managed by a CEO and possibly even a team: professional accounting, marketing, administrative, clerical, reception, all these services and functions. And of course, the negative is if you're younger and you want to join an established partnership, an established firm, you're going to have this early bird gets the worm problem, because you're going to look at the formula for revenue sharing, and you're going to realize that you've got a long ways to go. That partnership, to use our example of the 5 original lawyers, you have to get to $5 million a year and help the firm get to that level before you even see a penny. And the penny you will see will be a fractional penny, as we've talked in our examples. Partnerships, really good way for people like accountants, lawyers, doctors, psychologists, and even other professions to work together to become more powerful in the economy, get some good revenue and income distribution, have somebody else do the work for the administrative work for you, and also then fulfill your career in perhaps, exciting and interesting ways, and with the tax consequences being up to you because the distributions go to you personally, and you'll have to be careful about how you handle your affairs, whether it's through a family trust or a management corporation or some other way to receive your partnership draws and distributions. Oh, by the way, last thing I'll say is during the year, as income flows, there may have to be a line of credit because income might flow up and down in kind of a non-smooth way. So partners will take what they call a draw, which is an amount of money that is agreed upon ahead of time based on cash flow and based on years of experience. It's a draw, so it's money that comes to them, and then at the end of the year there's a settlement, and it could be that there's a further additional distribution, or in the case of a surprise late in the year, there might have to be a clawback. And so when you are in a partnership situation, don't forget that the draw is a valuable feature, yes, because it gives you income right away. You don't have to wait till the end of the year to see the results, but you do have to wait till the end of the year to see the results for the final, let's call it the netting out, the final calculation that tells you whether there's more coming to you or that you have to pay some back or, move it on into the future, that sort of thing. So there you go. Partnership, a very interesting model, and it's one that it really is worth considering, I'd say, with its complications. It's the Catholic CEO, Henry Kutarna. Thanks for joining us today, and we'll see you next time.